So the first type of trade we're going to put is a longer term trade. So hopefully you've gone through all the technical analysis tools that were in the previous lectures. Those will be very helpful. So now what we want to do is take a longer term trade. So if I wanted to take a longer term trade, first of all, I would need to have a bigger chart. So I want a 1-year daily chart. So that's what this is. And then in the studies, I don't want these close moving averages. So what I'll do is I'll put a 20 and a 50, and that's good enough. I don't want a third one, so I'm just going to put 2. The blue is the 20 and the purple is the 50. So now we're looking at gold, but I want to buy something that has gone down quite a bit. So, and now Chipotle is actually a good candidate. If you see, Chipotle hit a high of 758, but then it ran into some legal issues. And so from 758, it got chopped into almost half. And now it's rising back up to 518. Some of its problems are still open, but the company is very proactive in terms of tackling those problems. And so I feel Chipotle has a good potential to move up to 600, 650 over the next 6 to 12 months and recover all this lost ground. If you look at our positions, I'm already short Chipotle. Now that's a shorter term trade. We're not going to worry about that. But if I take a long position, if I buy Chipotle, it's going to buy 10 to cover this first. I want to take an options trade. I'm going to go out on Chipotle, let's say about 330 days. So almost 1 year on Chipotle, and I'm going to buy what you would call an out of the money option. This option expires in 332 days, and I want to buy the 650 call option. So that's going for about $25 right now, because this is a long-term trade, and that's why I've given all these days. So I'm going to buy this option. Buying a call option is bullish. So as the stock goes up, the value of this call option also should go up. This is for 10 contracts. 10 contracts is like 1,000 shares. I'll be paying about 25,000 for this. Yep, 25,000. And let's go ahead and put that. So now I got a Chipotle call option also into the portfolio. So if you look at Chipotle, I have minus 10, which is short the shares, and I have 10 contracts of a call option, the 650 call. So basically what I'm saying is over the next 1 year, Chipotle is going to try to move from 518 closer to 600, 650. Now, as it moves up, the value of this option is going to go up. So we can take the profits anytime on that call option, and we'll monitor this trade as well. The second kind of trade we're going to put is a swing trade. So swing to position. So basically about a month, maybe a month and a half, 2 months, that kind of a trade. And so what I want to pick is something that I feel will go either up or down in the next 20 days or 30 days, and to take advantage of that. And let's go take a look at Google. As you can see, Google also went up all the way to 810 and then came down. I would say that Google has the potential to come down. So either I can sell Google shares or I can buy a Google put option. So this is actually, these things are a good example to introduce you to how these options work. And so now I don't want to go to 332 days because that's not my trading time frame outlook. So my outlook is only for about a month or so. So I can go to this 52 days left, and so I can go into April. The advantage of coming closer is that your option prices are going to be much less. And so what I want to do is buy a 675 put option. Now I think because it's going to go down, Google's going to go down, so I want to buy a put option because put options increase in value as the stock goes down. Now I could be right or wrong. I'm just taking these trades to show it as an example, but let's see what happens and let's see how these trades play. All right, so that got filled. I gave it a little bit more than the mid price. And so we have Google also now. You should see Google. Now we have a put option at the 675 strike price. And so that is also part of this trading portfolio now. And then finally, I want to look at a short-term trade, which is like either a day trade or maybe 1 to 2 days. Yeah, so I think Apple's not a bad candidate for a short-term trade up to, maybe 96, 97, 98, somewhere there. So let's go and buy Apple. So here I'm just going to buy the shares itself. So let's buy 100 shares of Apple at $95.25 or 26. Let's confirm that. And all right, so these are three positions that we have now on the trading styles. So first of all, let's just recap all our positions here. Apple, we just got into in this lecture. CMG, we already had a short from before. Now we added a call option, 650 call option. Now Google, we added a put option. And Priceline, we already had 5 shares from before that has a little bit of a profit. XLF also we got in this morning, and that's got a small loss. So these are our trades right now, open trades, and we're going to monitor it. Even though we go to other sections, I'll keep providing an update on these trades, and perhaps we'll get into more trades as well. And hopefully this section has given you a good idea of how to use technical analysis. In fact, let's go ahead and let me show you some other things as well. I want to show the Bollinger Bands. So let me edit the studies. I want to take off the moving averages. I want to show the Bollinger Bands on Apple, and you don't need to make any changes. So these are the Bollinger Bands. It's in the middle of the band. If you recall, Bollinger Bands, as it crosses one of these, the lower band or the upper band, statistically, it'll tend to move the other way. Here we have, it's right at the middle band. So it's, it may go up, it may go down. Google is again right in the middle. Let's look at Facebook. Facebook went above the upper band and now it's turned back towards the center. Tesla was weak. Yeah, Tesla also went below the lower Bollinger Band. Now it's retracing to the middle. So basically it looks like all stocks are generally retracing towards the middle. So it doesn't matter. So we're going to track these trades and we'll provide updates as we go along. But hopefully this section has given you a very good introduction to technical analysis tools. Use it to time your trades. Look at the charts, see where some big volume points are coming in, because that's obviously smart money is very active at that time when you see very high volumes. Okay, just before we wrap up this section, I do want to show how I would do some kind of risk management just in case the stocks don't perform as we expect. So let's see first. Now you can see Chipotle is moving up. It's still negative for the day, but you can see that the option has made $550 already. So this is really a great profit right there. And so on Google also is moving up. And so our put option is losing money. So remember, put options make money when the market or the stock goes down. But now Google is recovering a little bit. So that's okay. Let's leave it as is. And then we have Priceline also somewhat recovering. So our losses are reduced on that. And we have the XLF. Now, the ones that I would be concerned about is Google, because if the markets do recover, then I don't want a put option to just be out there and keep losing money. So what I would want to do is I would come here and go to Google. Here, what I can do is right here, I can say create a closing order, sell 10. So I want to sell now because I have 10 plus 10 contracts. I want to sell 10. However, I don't want to sell it now. I want to make it a stop order. So instead, I want to put a stop loss on that. So now I don't want it to go, the price of this option to go below 11. So I want to make the stop at 11. And if that's the case, I want to sell Google. So right now, the mid price is 1160. We are down $300. And if it closes at 11, then we'll be down another $600. But I don't want to go more than that. So that's the stop. And it'll send it as a market order. And so we might want to put a stop limit and say the stop limit would be 10.7. So that's the lowest it can execute. If Google crashes suddenly, then the price might go lower than 10.7. And in that case, this trade won't get executed. So that's the risk I take by putting a stop limit. But nevertheless, let's trigger, the stop trigger itself is going to get triggered when this option mark price reaches 11. And then it's going to execute with a stop limit of 10.7. So I'm going to put that there, and that will be in waiting status at the orders, working orders would be 1. So this is the stop. That's the limit. So this will remain in working order. I want to cancel and replace it because I don't want this to get cancelled at the end of the day. So I'm going to put a good till cancelled. This order will remain open even after today, so tomorrow and the day after and all of that. So I want to protect Google. So this is how you would put some kind of risk management if you were concerned that one of your positions might run away from you and incur a lot of losses. Then you would want to keep some kind of a stop loss mechanism into the trade itself. So from now we're going to move into other asset classes. I think we're going to look at fixed income and bonds in the next section. And then we'll go on to Forex and commodities and some of the other ones, futures and options. Thanks.